Welcome to Striking Option, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how are you?
I'm doing great. Well, it's the last month of the quarter, and trade tariffs continue to dominate the headlines. Will we see a resolution soon?
You know, I think it's pretty doubtful. Anything that may happen, maybe it's going to happen before the end of the year, but in the short run, I don't think so.
Well, it seems that we're getting close to a resolution. All of a sudden, it backs off in August.
Exactly.
What a whipsaw it was in the month of August. But seasonally, in September, we do see a down month. Are we going to see a historical seasonal month in September where we're going to be in a little bit of a downdraft?
You know, this year has been so hard to predict. It really has been the last couple years. So I think really anything goes here, Jeff.
All right, fair enough. Well, let's get into this first lightning round. You ready?
All right.
Gold on the move. Well, gold has continued to move higher in all of 2019. Is there more room to run? Because 1600 seems like the next stop.
It really does. And there is so much momentum in this space right now. So what I'd like to do is buy a week 2 1575, 1605 call spread in gold. And this spread will cost an investor about $470. And it expires on Friday, September 13th.
Well, interesting. Friday, September 13th is the expiration. But talk to me a little bit, because right now we saw the October futures contract trading around 1548 when this trade example was priced out. Then the at-the-money volatility. We talk a lot here on Striking Option about the at-the-money volatility. It was above 16. That seems to be a little bit of an expensive premium, but at the end of the day, are you trying not to fight the move in gold?
Yeah, that's exactly what it is, Jeff. Above 16 is very, very expensive. However, there is so much momentum, so much tailwind in the space here. That's why I really like this.
No, that makes sense. And typically here on Striking Options, we like to be a seller of premium, but this case, Scott brings up a great point, to be a buyer of this premium.
Yep.
Always great stuff. And please remember, these are trade examples, not trade recommendations. You ready for the second lightning round, pal?
Absolutely.
End of quarter. Well, we talked about it. We have seen a pretty volatile Q3. What are your thoughts? Are we going to see a continued whipsaw like in August, or are we going to see this resolution? The market really needs a resolution, but at the same time, we're seeing treasuries being bought. The uncertainty, the global uncertainty, is still out there.
Yeah, and that's not going away anytime soon, especially with earnings now behind us. You know, that just really sets us up for some continued volatility here.
Well, the continued volatility allows a lot of opportunity in the marketplace. And it's interesting to see that in the face of all the headwinds this summer, the overall equity markets here domestically gained about 6%. So the resiliency of the stock market continues to really confuse people. But my trade example, Scott, I'm thinking about owning the market at a certain level. What are your thoughts about owning the market at a certain level?
Well, you know, we've been range bound in this level that I believe you're going to talk about here for about the past 6 months. So if we come back down to there and there's a major support, have at it.
Well, you hit the nail on the head. So we talk about this range-bound opportunity. And I want to be a seller in my trade example of the week 2, expiring Friday the 13th as well, 2850, 2800 put spread in the E-mini S&P 500. This will allow an investor to collect about $430. It's really interesting to see that 2850 level. It has shown a lot of resiliency and a little bit of a bounce in the month of August.
Absolutely. Now, here's an example with that at-the-money volatility, which is 19.3, is really expensive, and we're talking about selling the expensive premium. But what's real interesting, Jeff, is another way to approach this could be using the Micro E-mini futures. And a way to express this would be by buying 5 Micro E-minis at that level at 28.50.
No, that's a great point you bring up. And if you're interested in that technical level, if you like that 2850 level, using the Micro E-minis makes a lot of sense. You can have both these strategies on, and that's the beauty of utilizing and implementing micros into your strategy. You have 1/10 the exposure of the typical E-mini S&P 500, Scott.
Absolutely, and it allows you to really just kind of get in and get out and just kind of hedge yourself along the way.
No, great stuff, Scott, and thanks as always for coming on Striking Options, and please tune in every week as we will continue to strike options.